What if I told you that most investors look at income ETFs the wrong way? They pull up a chart, see the price going down, and immediately say, this ETF is garbage. And in many cases, they're right. Steady NAV or price erosion is usually a red flag. But here's the thing, price erosion alone doesn't tell you the full story. It's not the best measure of whether an income ETF is actually making you money. In this video, I'm going to share a much simpler way to approach income investing. It'll make the whole process easier, save you a lot of headaches, and most importantly, help you see whether your income ETFs are actually building wealth for you or just spinning their wheels. It shows you if the ETF is draining your capital slowly or if it's actually building wealth. Because at the end of the day, the purpose of investing isn't to chase high yields or to obsess over price charts. It's to grow and preserve wealth so you can fund your lifestyle today and decades from now. Now, let's put this into perspective with inflation. As of July 2025, inflation in the US is running at about 2.7%. So what does that mean? It means the cost of everyday goods and services is about 2.7% higher than it was a year ago. In practical terms, $100 last year now only buys you $97 worth of goods today. Here's why that matters. At 2.7%, your purchasing power is quietly slipping away. If your money is sitting in cash earning close to nothing, you're losing ground every year. That's why investing is so important. It's not only about trying to grow your money, it's also about making sure your money doesn't lose value over time. If your returns don't beat inflation, your dollars are buying less every year, even if the balance in your account looks the same. At today's level, that means you need at least 3 to 4% annual returns just to break even in real terms. That's the minimum hurdle every individual faces. At the very minimum, your investments should beat inflation. If inflation is 2.7% and your portfolio only earns 2%, you're actually losing money in real terms. The higher above inflation you get, the better. For example, if inflation is 3% and your portfolio delivers 8%, your real return is 5%. That's the part that compounds and grows wealth over time. The challenge is finding investments that can consistently outpace inflation without exposing you to unnecessary risk. And this is where individual goals matter. If you're retired, you might only need to earn 2 or 3% above inflation while drawing steady income. That's enough to protect your lifestyle. But if you're a younger investor with decades ahead, you may want to target 5 to 7% above inflation to compound more aggressively. So the rule of thumb is simple. Your investments need to outpace inflation. How far above depends on your goals and your tolerance for risk. The higher you go, the faster wealth compounds, but you have to stay within a range you can actually live with. Now, at this point, you might be asking, can I really make 5 to 8% every single year? Here's the honest answer. Over the long run, yes, that's realistic. But in the short term, no. Markets don't move in straight lines. Some years you'll see gains of 20% or more. Other years you might be down 15 or 20%. The averages work out over decades, but not year by year. There are a couple of reasons for this. First, markets move in cycles. Bull markets can run for years and deliver strong returns. Bear markets can wipe out a big chunk of progress in just a few months. Second, inflation keeps moving the goalpost. If inflation is 2% and you earn 7, you're 5% ahead in real terms. But if inflation spikes to 8, that same 7% return actually puts you behind. So the takeaway is this. Don't expect 5 to 8% returns every single year. That's not how markets work. The real goal is to average that range across decades, through both the good years and the bad. That's how you preserve purchasing power, outpace inflation, and allow wealth to compound over time. Over the past century, US stocks, and the S&P 500 in particular, have been the most reliable long-term inflation beater. On average, the S&P 500 has returned about 10% a year. Inflation over that same period has averaged roughly 3%. That means investors earned around 7% real returns above inflation, compounding wealth in a way no other asset class has done as consistently. Why is that? Because companies have pricing power. When costs rise, they can raise prices on the products and services we all buy. That flows into higher revenues, higher profits, and ultimately, higher stock prices and dividends. Now for income investors, I get it. You want cash flow. Everyone wants income. But here's the real question. If your income ETF isn't outpacing inflation in terms of total return, are you actually growing wealth? The trade-off with many income ETFs is simple. You're giving up some upside in exchange for monthly or weekly cash flow. And that's fine, as long as you know how much you're giving up and it's worth it to you. But here's the important part. This trade-off doesn't have to be stressful if you frame it correctly. If your ETF is paying you steady income and still compounding 5 to 8% above inflation in total returns, you're accomplishing the real goal of investing, building wealth in real terms. Where investors often go wrong is chasing the highest yield blindly. A smarter approach is to make sure you're beating inflation comfortably first, then focus on income. And if all of this sounds complicated, here's the simple shortcut. The S&P 500 has been a consistent inflation beater for over a century. So just compare your income ETF's total return to the S&P 500 total return, either since inception or since you started owning it. That way you'll know if your ETF is truly helping you build wealth or if the income is just a short-term distraction that's hurting you in the long run. With that in mind, let's dig into the numbers. We're going to look at some of the most popular income ETFs and see how they've actually stacked up against the S&P 500 since their inception. To do this, I'll be using Dividend Channel's Dividend Calculator tool. Now, here's an important note. We'll be comparing them without dividends reinvested. These funds are marketed as income products. They're not designed to be long-term compounding growth machines. If you're reinvesting every dividend back into the fund, you're essentially treating it like a growth investment, waiting for the value to build over time. These funds are marketed as income vehicles, cash flow you can spend or use today, so that's exactly how we'll evaluate them. We'll start off with ULTY. Since its launch, the results have been pretty eye-opening when stacked against SPY. Let's say you invested $10,000 into both on February 29, 2024. By September 16, 2025, here's how that money would look. ULTY began at $19.35 a share. Fast forward a year and a half, and it's trading at just $5.64. That's a dramatic decline in price. The one offsetting factor is the dividends. It's distributed $14.20 over that period. But when you put it all together, the total return comes out to only 2.5%. Your $10,000 would have turned into about $10,251, essentially flat. Now let's compare that with SPY. Over the same time frame, the SPY climbed from $508 to $660 per share, while also paying out $10.52 in dividends. That brought its total return to nearly 32%. A $10,000 investment would have grown into about $13,198, so the gap here is enormous. ULTY barely moved the needle, while SPY produced over $3,000 in gains. And this really illustrates the reality with many of these high-yield ETFs. You may see big cash distributions, but the underlying price erosion can neutralize most of that income. I also want to take a moment to compare ULTY from the point where some investors say it changed its strategy. I bring this up because anytime you talk about ULTY's performance, there's always pushback. ULTY investors will argue that looking at results since inception is cherry picking, and that you need to measure from when they supposedly updated the strategy earlier this year. But honestly, if you think about it, isn't that also cherry picking, just in the other direction? The real question is, when did this change actually happen? Some say March, others say April. If you go to their website, the latest prospectus is dated February 28, 2025, and on page 10, it outlines 6 option strategies: selling calls, selling credit spreads, selling diagonal call spreads, selling cash secured puts, selling calendar call spreads, and selling collars. The thing is, those exact strategies were already listed in their August 16, 2024 update. Same language, same strategies. So did ULTY really pivot in the last few months? Or has it been operating the same way and just benefiting from a favorable market? A lot of people point out that markets over the past 6 months have been bullish. Meme stocks running wild, leverage and margin pouring into speculative trades, and a general risk-on environment. That backdrop alone can make an aggressive options-based fund look brilliant. Others argue the fund started going weekly and layering on protective puts, which is what gave it a boost. To keep things simple, I'm going to use April 4th, 2025 as the reference point. That's when you see a clear shift in ULTY's performance chart. And it's worth noting, that date lines up almost perfectly with the market itself beginning a strong rally. So it's hard to separate whether ULTY's recent run has been the result of a true strategy change or just good timing with an especially bullish market. Now let's take a look at ULTY's performance from April 4th, 2025. If you put $10,000 into ULTY on that date, here's what happened by September 16th. The share price went from $5.45 to $5.64, a very small move in price. But the fund delivered $2.21 per share in dividends over that short period. Altogether, the total return came out to 44%. That turned your $10,000 investment into $14,404 in less than half a year. Now compare that to the SPY over the same stretch. It rallied hard, moving from $505 a share to $660. Along the way, it paid out $1.76 in dividends. The total return came in at just under 31%, which still would have grown your $10,000 to about $13,097. So in this specific window, ULTY actually outperformed the SPY by a wide margin. This is the kind of chart that excites the ULTY community and gives fuel to the idea that the strategy shift is working. But we also have to acknowledge April marked the beginning of a broad market rally. So the question is whether ULTY's strength came from a real strategy change, or if it simply rode the wave of a very bullish environment. Only time will tell. Let's move on to XDTE and see how it's done compared to the SPY since March 7th, 2024. If you had invested $10,000 into XDTE on that date, here's where you'd stand by September 16th, 2025. The share price started at $52.46 and slid down to $44.25. So, price-wise, you actually lost ground. But this ETF offset a lot of that decline with its distributions. $18.80 was paid out during the period. That steady income brought the total return to 20.18%. Your $10,000 would have grown to about $12,018 in a year and a half. That works out to a 12.8% annualized return. Now compare that to the SPY. Over the same period, the S&P 500 rose from $514.81 to $660, while paying out $10.52 in dividends. That was good for a 30.25% total return, or nearly $13,025 from the same $10,000 investment. Annualized, that's about 18.9%. Lastly, let's take a look at how YMAX has performed against the SPY since January 17th, 2024. If you invested $10,000 into YMAX, the shares started at about $19.90 each. Fast forward to September 16th, 2025, and the price had fallen all the way down to $12.85. That's a big drop, more than a third of the value gone. But during that same period, YMAX paid out $13.11 in dividends. When you combine everything, the total return came out to 30.46%. That means your $10,000 investment grew to just over $13,000. Now compare that to SPY. Over the same time frame, SPY climbed from $472 per share to $660. That's almost a 40% gain just in price appreciation. And it also paid out about $10.52 in dividends. Put together, that worked out to a 41.97% total return, turning $10,000 into more than $14,000. At the end of the day, the goal for every investor is simple: preserve and grow your wealth, because inflation is relentless. It's always there, always trying to chip away at your purchasing power. Your job as an investor is to maximize the opportunities you have to outpace inflation, and to do it in a way that's comfortable and sustainable. That's how you make sure your purchasing power grows, not just today, but for years into the future. Now, how far above inflation you want to aim depends on your goals and your risk tolerance. For some, beating it by a few points is enough. For others, it may be about compounding aggressively. But if you're not beating it at all, the results can be detrimental. You're effectively losing ground even if your account balance looks the same on paper. That's why the real focus isn't just income or just growth. It's about making sure your strategy consistently puts you ahead of inflation, so your wealth compounds in real terms. So that's the bigger picture. Investing isn't about chasing the highest yield. It's about making sure you consistently beat inflation, preserve your purchasing power, and grow wealth you can rely on for the future. If you got value from this breakdown, make sure to hit that like button. And if you want more data-driven ETF analysis and smart investing insights, don't forget to subscribe.